Something happened in the silver market over the past several weeks that most retail investors never noticed, but almost every trading desk that handles physical metal noticed immediately. It didn't come from a headline or a press release. It showed up quietly in the plumbing of the market in numbers that rarely make it into financial news. Once you understand what that number represents, it explains why a few of the more experienced traders in this space have gone unusually quiet lately. Silver doesn't behave like gold. Gold is largely a monetary metal. People hold it because they don't trust something else, whether that's a currency, a government, or the stability of the financial system. Silver carries that same monetary identity, but it also lives a second life as an industrial commodity. It goes into solar panels, electronics, medical equipment, electric vehicles. That dual identity is why silver tends to move in ways that confuse people. Sometimes it acts like a safe haven. Sometimes it acts like a bet on global manufacturing. And every so often it does something that fits neither story, which is usually the moment worth paying attention to. That's roughly where we are right now. Start with the plainest observation, the one anyone can verify. Physical silver inventories sitting in COMEX registered vaults have been drawing down at a pace that doesn't match the pace at which new supply is entering the system. Registered inventories are the metal actually available for delivery against futures contracts, as opposed to eligible inventories, which are simply stored there without necessarily being available to settle a contract. When registered stocks fall while eligible stocks stay flat or get converted into registered categories to meet demand, that tells you metal is being pulled out of the system faster than it's being replaced. That's not speculation. That's a plain description of what the inventory reports show. On its own, an inventory drawdown doesn't prove anything dramatic. Inventories fluctuate. They always have. What makes this particular drawdown notable is the context around it, and that context is where the story starts to take shape. Industrial demand for silver, particularly from solar panel manufacturing, has been rising for several consecutive years, largely because photovoltaic cells use silver paste as a conductor, and there isn't yet a commercially scalable substitute at the volumes the industry needs. At the same time, investment demand, meaning coins, bars, and silver-backed ETFs, has also been climbing, driven by the same macro anxieties that have pushed gold to repeated highs. So you have two separate sources of demand, industrial and monetary, pulling on the same finite pool of above-ground metal at the same time. Historically, when industrial demand and investment demand rise together, the market resolves the tension through price. Price goes up, mining supply eventually responds, and the system rebalances over a few years. That's the textbook mechanism. But there's a wrinkle. Silver mining is unusual because roughly 70% of global silver production doesn't come from silver mines at all. It comes as a byproduct of mining for copper, lead, and zinc, which means silver supply doesn't really respond to silver prices the way gold supply responds to gold prices. A copper mine doesn't ramp up production because silver got more expensive. It ramps up based on copper economics. So the usual pressure valve, higher prices bringing more supply online, works far more slowly in silver and sometimes barely works at all. Most casual investors never learn this distinction because it doesn't show up in headlines. It shows up in supply data buried in reports from the Silver Institute and in mining companies' own production disclosures. So now you have a market where demand is structurally rising from two independent directions, and supply has limited ability to respond quickly. That alone would be worth discussing. But there's a third factor that explains why some analysts are treating this as the most important signal of the year. Lease rates. If you've never encountered the term, here's why it matters. When large holders of physical silver, bullion, banks, refiners, institutions lend that metal out temporarily to other market participants, they charge a rate for the loan, similar in spirit to an interest rate. Under normal conditions, that rate sits low and stable because there's plenty of available metal willing to be lent. When lease rates spike, it usually means the opposite. The people who actually hold physical metal are becoming reluctant to lend it out, either because they need it themselves or suspect they might soon. A rising lease rate is the market signaling that physical metal is getting harder to source at a reasonable price, even before the quoted spot price moves dramatically. Silver lease rates have recently moved in a way that's drawn direct comparison among traders who watch this closely to conditions last seen during acute stress periods in the physical market. That doesn't mean any specific prior event is about to repeat. Market conditions are never identical twice, but the mechanism, tightness in physical availability showing up in the lending market before it fully shows up in price, is a documented historical pattern, not a new theory. If physical tightness is building beneath the surface, why hasn't price already reflected it more dramatically? That comes down to how the paper market and the physical market interact imperfectly. Most silver trading happens through futures contracts and other derivatives, not through anyone actually taking delivery of metal. Paper silver trades in volumes that dwarf the physical metal actually available. Under most conditions, paper and physical prices track closely enough that the distinction doesn't matter to most investors. But when physical tightness builds while paper markets stay liquid and heavily traded, you can get a temporary disconnect where the quoted price understates what's actually happening to available supply. That gap tends to close eventually, sometimes gradually, sometimes abruptly, and abrupt closures have historically coincided with some of silver's sharpest short-term price moves in both directions. That last part matters because it's easy to hear a story about tightening supply and assume the only outcome is higher prices. That's not how markets work. Tight physical conditions can coexist with sharp volatility in both directions, particularly because so much of the silver market is dominated by leveraged futures positioning. A supply squeeze can trigger a spike. It can also trigger a violent unwind if speculative longs get overcrowded and then get forced out during a liquidity event. Anyone claiming certainty about which comes first is overstating what the evidence supports. So look at this from three angles, since that's the fairest way to evaluate a market this complicated. The bullish case rests on the convergence already covered: structural industrial demand from solar and electrification with no sign of slowing, investment demand rising alongside gold as a hedge against currency debasement and geopolitical uncertainty, supply that responds sluggishly because most of it is a byproduct of other metals, falling registered inventories, and rising lease rates suggesting physical scarcity. Historically, this combination has preceded meaningful upward repricing in silver, sometimes with a considerable lag between the underlying tightness and price catching up. The bearish case deserves equal weight. Silver is a smaller, thinner market than gold, which makes it far more sensitive to speculative positioning. A significant portion of recent price strength has come from momentum-driven futures buying rather than pure physical accumulation, and momentum-driven markets are prone to sharp reversals once sentiment shifts. If global manufacturing activity slows, whether from a broader economic downturn or a pause in solar installation growth in major markets like China, industrial demand could soften faster than expected, easing some of the current pressure. And if central banks keep real interest rates higher for longer, that raises the opportunity cost of holding a non-yielding asset like silver, which has historically dampened investment demand regardless of supply conditions. The neutral case is probably the fairest reading. Right now, the data shows real tightening in physical availability. But tightening alone doesn't tell you the timing or magnitude of any price response. Markets can stay tight for extended periods without an obvious breaking point. They can also resolve that tightness through demand destruction, meaning industries and investors simply pull back on purchases once prices rise enough to change behavior, rather than through a dramatic supply shock, as for which case currently has the strongest support. The physical tightness signals falling registered inventories, elevated lease rates, and dual-source demand from industry and investors are not in dispute. Those are observable, documented conditions. What's uncertain is the timing and the pathway by which that tightness resolves. History has examples of both outcomes. Sometimes physical tightness builds for a long stretch before finally forcing a sharp repricing. Other times, price adjusts gradually enough that no single dramatic event ever occurs, and the market simply absorbs the pressure over months or years. There's a historical comparison worth making carefully. Since history doesn't repeat mechanically, though it rhymes in useful ways, during prior periods when silver lease rates spiked alongside falling exchange inventories, the metal experienced some of its largest short-term percentage moves of the decade that followed in both directions. What made those episodes notable wasn't that any single analyst called the exact trigger. It's that the underlying physical conditions were visible well before the price move for anyone watching inventory and lending data rather than just the daily chart. Physical tightness tends to show up in the plumbing before it shows up in the headline number, and by the time it becomes an obvious headline, a meaningful part of the move has often already happened. Who benefits from this kind of environment and who's exposed? Long-term holders of physical metal, whether retirees holding coins as a store of value or institutions with allocated bullion, tend to be relatively insulated from short-term volatility because they're not relying on leverage or timing. Their real risk is opportunity cost. If prices stay flat or decline for a while, not a structural risk to their holdings. Leveraged futures traders are exposed on both sides. If tightness resolves through a sharp upward move, over-leveraged short positions can face rapid losses, a dynamic sometimes called a short squeeze. But if sentiment shifts and momentum, longs get crowded before any actual supply shock materializes, those same leverage positions can unwind just as violently the other way. Industrial users face rising input costs if tightness pushes prices meaningfully higher, which over time could accelerate substitution research, meaning engineering designs that use less silver per unit. That's happened before in industrial history, and it's a real check on how far industrial demand-driven scarcity can push prices before the market adapts. What are professionals actually watching beyond the headline spot price? Registered COMEX inventory trends updated regularly and publicly available through the exchange. Silver lease rate data, less discussed in retail media but closely tracked by refiners and bullion banks. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. When that ratio sits at extreme elevated levels, it has sometimes, though not always, preceded periods where silver outperforms gold as the ratio compresses back toward more typical historical ranges. And positioning data from the Commodity Futures Trading Commission's weekly Commitments of Traders report, which shows how exposed speculative funds are relative to commercial hedgers, offering a rough gauge of how crowded or stretched current sentiment has become. Which assumptions here might be wrong? The bullish framing assumes industrial demand keeps its current trajectory, but energy transition policy can shift with political cycles, subsidy structures, and trade policy, particularly around solar manufacturing, which has already seen tariff disputes affect global supply chains. It's also fair to question whether lease rate spikes always resolve toward higher prices. They can normalize simply because more metal gets pulled out of storage and made available, easing pressure without a dramatic price move at all. On the bearish side, it's fair to ask whether a broader economic slowdown, if one materializes, would hurt silver demand as much as some assume, since periods of financial stress have historically boosted silver's monetary demand, even while hurting its industrial demand, with the two effects partly offsetting each other. So where does that leave an investor trying to make sense of all this? The underlying physical conditions in silver right now are unusual enough to deserve real attention, not casual dismissal. Falling registered inventories, rising lease rates, and demand from both industrial growth and monetary hedging together represent a combination that hasn't historically stayed unresolved indefinitely. But the specific path forward, a sharp repricing, a gradual multi-year adjustment, or a temporary cooling as industrial demand or leverage positioning shifts remains uncertain. Anyone telling you otherwise with total confidence is selling certainty the market doesn't actually offer. What's worth carrying away from this video is less a prediction than a different way of watching the market. Most people only look at the number on the chart, and the number on the chart is usually the last thing to move, not the first. The lease rates, the inventory reports, the ratio between gold and silver, these are where the story tends to start. By the time it reaches the price everyone's watching, a meaningful part of the move has often already happened quietly in the parts of the market that don't make headlines. So consider this. If the physical plumbing of a market is already showing signs of stress well before the price reflects it, what does that tell you about how much of what moves markets is actually visible to the average investor in real time, and how much of it happens in places most people simply never think to look? If this kind of analysis is useful to you, liking the video and subscribing helps more people find grounded, evidence-first breakdowns like this instead of the noise that usually surrounds precious metals content. And if you want to understand how the gold to silver ratio has behaved across previous market cycles and what it's historically signaled at extremes like the one we're seeing now, there's another video that walks through exactly that, and it's a natural next step from everything covered here.